We are tackling the complexities of TILA and TRID for the national portion of the real estate exam. This is one of the most technical areas of the test because it involves specific timelines and document names that you must get right to pass. The Truth in Lending Act, or TILA, is also known as Regulation Z, and its primary goal is to ensure that credit terms are disclosed in a meaningful way so consumers can compare different loan products. On the exam, you will often see questions asking about the annual percentage rate, or APR. You must remember that the APR is not the same as the simple interest rate. While the interest rate is just the cost of borrowing the principal, the APR reflects the total cost of the loan over a year, including origination fees, prepaid interest, and mortgage insurance. If a question asks which number a consumer should use to compare the true cost of credit between two lenders, the answer is always the APR. Another critical exam point for TILA is the right of rescission. This gives a borrower 3 business days to cancel a loan agreement after signing. However, a common trap on the exam is applying this to the wrong type of transaction. The right of rescission applies to home equity lines of credit and refinances on a primary residence, but it does not apply to a mortgage used for the initial purchase of a home or a construction loan. If the exam scenario describes a buyer purchasing their first house, they do not have a 3-day right to change their mind under Regulation Z. Moving into TRID, which stands for the TILA-RESPA Integrated Disclosure Rule, you need to know the 2 primary forms, which are the loan estimate and the closing disclosure. These documents replace the old good faith estimate and the HUD-1 settlement statement. The loan estimate must be provided to the consumer within 3 business days after they submit a loan application. The exam might ask what constitutes a completed application, and you should look for the 6 pieces of information, which are the name of the borrower income, their social security number, the property address, the estimated value of the property, and the loan amount. The closing disclosure is the document that summarizes the final loan terms and costs. This must be provided to the borrower at least 3 business days before the loan is consummated. Consummation is the technical term for when the borrower becomes legally obligated to the creditor, which usually happens when the loan documents are signed. If there are significant changes to the loan, such as an increase in the APR by more than 0.125% or a change in the loan product, a new 3-day waiting period is triggered. A major confusion point on the exam involves how we count days. For the loan estimate, business days are any day the creditor offices are open to the public. For the closing disclosure, delivery business days are defined more strictly as all calendar days except Sundays and legal public holidays. This is often called the specific business day definition. If you see a question about a federal holiday falling within the 3-day waiting period, remember to skip that day in your count. One mnemonic to help you remember the timing for TRID is the phrase 333. You have 3 business days from application to receive the loan estimate, and you must have 3 business days to review the closing disclosure before you sign. This rule is designed to prevent surprises at the closing table, so the borrower is not seeing new fees for the first time while the notary is waiting. When it comes to advertising, TILA has very strict rules about trigger terms. If an advertisement mentions any specific number related to the loan, such as the down payment amount, the monthly payment, or the number of payments, it triggers a requirement to disclose all of the terms, including the APR. A common exam trick is showing an ad that only says low interest rate or easy financing and asking if it triggers full disclosure. The answer is no, because these are general claims. But if it says 10% down payment, then it is a trigger term and every detail must be listed in the ad. Finally, remember that TILA and TRID apply primarily to residential loans for 1 to 4 family dwellings. They do not apply to commercial loans, large agricultural loans, or business credit. On the exam, if you see a scenario involving a commercial warehouse or a large corporation, you can usually rule out these disclosure requirements. Mastery of these specific dates and definitions will ensure you pick up every point available on these federal regulations.